Hi, I'm Melanie Carter and welcome to Trade Talk. It's a great time to be a Canadian exporter, but let's face it, we could all use a little help boosting our sales. So today we're going to examine a simple yet effective strategy for growing your business and opening up new markets. Consider offering competitive payment terms. A little flexibility on your billing cycle will create a lot of goodwill with your customers. And we can never have too much of that, right? But if payments are slow to come in, how do you manage your costs? Well, EDC can help with that. We offer a credit insurance program that will make your products more competitive. More on that in a minute. But first, let's take a look at some of the factors that go into a buying decision. Pricing, quality of the product, reliability of delivery, customer service, and more often than not, the payment terms. Customers like to feel like they have a choice, not just in deciding which product to buy, but also in how they make their payments. Flexibility on your part may lead to a larger initial order and some repeat business. EDC's senior underwriter, Sarah Van Wold, has helped many Canadian exporters set up an extended credit system that is both flexible and reliable.
If you're offering a term that is not standard in a foreign market, it may be flexible for your business to go up to 60 days, but if that is the standard in that market, it could definitely help you be competitive and get additional sales. Also, if you have a seasonal business, there may be times of the year where cash flow is strong, you're blowing through a lot of goods, but during the opposite season, things are slower, so a company may offer longer terms to allow their clients to work through the inventory they've got, knowing full well that in the busy season they're going to be paid much faster. You will have that short-term shortfall of that extra 30 or 60 days if you're going to 60 or 90. So you do need to make sure you have that cash flow. Many companies use lines of credit with their banks that can help them bridge that gap when they're having an opportunity to put in the flexible terms. Accounts receivable insurance can help get additional margining on those lines of credit, so it is something, a tool that could be used to help with that. Know your customer and know your market. Those are definitely the two things that are key. Know whether it is standard in your market that you're going into, and know if your customer can pay you.
It's important to let your customers know that you may not be able to offer flexibility for every sale. After all, business cycles go up and down. But for a new relationship or for an important customer who might be having some temporary cash flow issues, showing goodwill and trust is never a bad idea. Credit management practices vary from business to business, and it's important that your sales team understand and follow an established set of rules. Clearly define the payment terms in the initial sales contract. Do a bit of due diligence as to your customer's credit history, and don't forget to regularly update their credit profile in your database. And finally, use a standard process for handling all overdue accounts. Also, don't forget to buy some credit insurance, because if worse comes to worse and your customers cannot pay, then you'll be covered. Having EDC's credit insurance as a safety net for your cash flow will help you drive new business while supporting all the hard work you've done to get this far. For more information, contact us at EDC. And in the meantime, I'm Melanie Carter, and keep talking trade.